Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Are you tired of sifting through multiple valuation metrics to determine the true value of a company? Well, today we're going to discuss a metric that Warren Buffett considers to be the most effective and his personal favorite. It's called free cash flow or owner earnings. But what exactly is free cash flow? How does it impact companies and its valuations? And as an investor, do you realize there an ETF which focuses on free cash flow as its main metric for selecting stocks? We'll dive into all of that and more. So, if you're ready to learn about the power of free cash flow and how it can help your investments, keep watching till the end. But before we jump in, make sure to subscribe to our channel and hit that notification bell, so you never miss out on our latest videos. Free cash flow is basically the cash that remains after a company pays to support its operations and makes any capital expenditures. Mathematically, free cash flow equals net cash from operating activities minus capital expenditures. Warren Buffett likes to call free cash flow the owner earnings because it's the money that's left over after a business pays its day-to-day operating expenses. So, you can think of free cash flow as the company's extra cash. And what can they do with this extra cash? Well, they have quite a few options. They can use it to pay off any debts they might have, or they can reward their investors by paying dividends or buying back their own stock. Alternatively, they can also use the free cash flow to expand their business in different ways. When it comes to valuing a company, free cash flow is definitely a metric worth considering. It tells you how much money the company has available to do things that can benefit its shareholders or help it grow. And hey, if it's good enough for Warren Buffett, it's definitely worth paying attention to, right? So, let's talk about how free cash flow impacts companies and investors. Positive free cash flow indicates that a company is generating more cash than it requires to sustain its operations. This surplus cash can be utilized to seize growth opportunities, serving as a strong indicator of financial flexibility and stability. On the other hand, negative free cash flow implies that a company is spending more cash than it generates, suggesting a potential need for external financing and reduced financial flexibility. Free cash flow is widely regarded as the most reliable measure of valuation and a critical gauge of intrinsic value. It showcases the amount of cash available to potentially reward shareholders or pursue growth initiatives. Not surprisingly, companies with substantial levels of free cash flow are often considered appealing options for investors. Now we know the importance of free cash flow, the next question is how do we select companies with high free cash flows? It turns out we don't actually need to do this ourselves, because there is an ETF which focuses on free cash flow extensively. It's called COWZ, with ticker symbol COWZ, which stands for Pacer US Cash COWZ 100 ETF. Let's dive into some of the fundamentals of COWZ so you can get a better understanding. The ETF was established on December 16, 2016, so it's relatively new but has a solid track record for investors to follow. It has a 5-star rating from Morningstar. Currently, it manages over $13 billion in assets, which is quite impressive. A high amount of assets under management indicates good liquidity, which benefits investors by providing tighter bid-to-ask spreads and fair pricing when buying or selling shares. COWZ tracks an index of companies selected from the Russell 1000 Index. The ETF starts with the Russell 1000 Index selection universe and screens companies based on their average projected free cash flows and earnings for the next 2 fiscal years. Companies with negative earnings or free cash flow are filtered out, and the remaining companies are ranked based on their 12-month free cash flow yield. The top 100 companies are included in the index, with a cap at 2% for an individual stock. The goal here is to provide broad-based exposure to U.S. large-cap equities, with the belief that higher free cash flow indicates stability. This selection process gives the COWZ exposure to opportunities in the market where high-quality stocks are trading at a discount. While Russell 1000 Index has a P/E ratio of 20.8, COWZ has a much lower P/E ratio of 7.26. As a result, companies with a high free cash flow yield have the ability to grow dividends over time. COWZ holds 103 stocks in its portfolio, and it undergoes rebalancing every quarter. Interestingly, sectors with the highest free cash flow typically include energy and utility, consumer goods, healthcare, and technology. Energy and utility companies, like oil and gas producers or electric utilities, often have stable demand and long-term contracts. Large consumer goods companies with popular brands can maintain pricing power and strong customer loyalty. Healthcare companies with successful patented drugs or medical devices can also generate significant demand. Established technology companies with successful products or services often have high profit margins and recurring revenue streams. All of the above can lead to consistent and substantial free cash flow. Now, let's take a look at COWZ Holdings' breakdown. Over 35% of its assets are in energy stocks, with healthcare, basic materials, consumer discretionary, and technology as its primary assets. However, it's important to note that the fund is rebalanced quarterly, so the allocation of assets can change. One sector missing from its holdings is financials, and this decision has proven to be smart given the struggles in the financial sector in recent times. The expense ratio of the COWZ ETF is 0.49%, which is reasonable given the active stock selection process. This means that for every $1,000 invested, you would pay about $5 in annual fees. Since its inception in 2016, COWZ has returned an average of 13% annually. If all dividend were reinvested for the period, COWZ's total return would have been close to 16% annually, easily outperforming Russell 1000 Index, which returned about 11%. Recently, we also talked about another popular value-focused dividend ETF called SCHD. How does COWZ compare with SCHD? Well, the historical performance of COWZ shows that COWZ outperformed SCHD in 1 year, 3-year, 5-year, and 10-year periods. Year-to-date, COWZ returned 4.4%, significantly higher than SCHD's -2.17% decline. More importantly, COWZ has a Sharpe ratio of 0.55 compared to SCHD's Sharpe ratio of 0.28. With all the promising results, there are also a few issues to consider. The COWZ ETF uses trailing 12-month free cash flow yield instead of forward-looking data, which can lead to overweighting cyclical sectors like energy even after their free cash flow yield declines. In addition, the fund's quarterly rebalancing results in relatively high turnover, potentially affecting the consistency of its dividend yield. But overall, I think COWZ ETF is a good choice for anyone who likes value investing. And that's it for today's video. If you enjoyed this video and want to see more content like this, make sure to hit that subscribe button and turn on the notification bell so you never miss an update. I would love to have you as part of our community. Also, don't forget to leave a comment below with your thoughts, questions, or any other topics you'd like me to cover in future videos. I always appreciate your feedback. Thanks again for watching, and I'll see you in the next one.